Bob, I think that Andy just laid out what happened. But we've seen so much volatility in bonds, really experienced people got the head handed to them many times as they're trying to anticipate the pivot, and we've seen it again. A lot of people asking, are things different this time? Are we in for a more prolonged period of volatility? Are we higher for longer? Has the labor market changed? Are we in this post-COVID world where do the models work now? As we try to figure out the trajectory that Andy just talked about, how are you viewing all of that?
Yeah, I mean, I think Andy did a nice job outlining where we are today, and I think the core of what's been the challenge for a lot of investors is that they haven't respected that script. I call it the order. Andy has a script. His script is much more elaborate than my order, which is fit on one tweet. But like this idea that, okay, there will be a point where inflation becomes lower, at the Fed's target. And in order to get there, there has to be a recession. Most people, to be clear, agree with that basic premise, right? The issue that the early pivoteers keep confusing is that there's an order to that, which is first the bond yields have to rise, then the stocks go down, then the economy weakens, and then we get inflation back to target. So if you buy bonds today while the economy's still hot because you think that there will eventually be a recession, that's out of order. That's not how it works. Or even worse, all those people buying stocks today, like people buying stocks today who are like, the Fed's going to pivot. It's like, okay, but why would the Fed pivot? The Fed pivots under conditions where economic activity is weak. Okay, so first you have weakness, then you have pivot, right? That's the order. And those orders are very important to keep in mind. And folks, I think because of the 40-year disinflation, many people are sort of thinking at the second that we get the tiniest bit of weakness in economic conditions, the Fed is going to immediately flood the economy with liquidity. And in an environment where inflation is still, from the Fed's perspective, elevated relative to their target, that's not how it's going to work. And so what we're seeing is actually a cycle that is more akin to what we saw maybe in the late 60s, that sort of dynamic going on, than it is, frankly, anything in our professional lives.